Angel is brought to you by Audible, with an unmatched selection of audiobooks, original audio shows, news, comedy, and more. Get a free audiobook with a 30-day trial at audible.com/angelbook.
Hey everybody, welcome to Angel, the podcast. I'm Jason Calacanis, an angel investor in 150 companies, 6 of which have become unicorns. And I love investing in companies and recently wrote a book called Angel. This is the podcast that continues the discussion we have in Angel about how you, an accredited investor here in the United States, could invest in startup companies and learn how to do it by maybe having less misses and more hits and lots of different techniques, things I've learned. It's a pretty opaque practice, this early stage investing, and very few books, if any, have been written, certainly none by somebody with 6 unicorns. Now, I don't say that to crow exactly, but that there is a technique and there is a place, a magical casino, where the number of hits outweigh the number of misses, and the deal flow is greater than other locations. And that place is called Silicon Valley. The number of huge hits coming out of here is just unprecedented. It's amazing the number of companies that have war chests of capital to buy small startups. Now, the majority of startups fail. We've all heard that statistic. But my guest today, Ben Narasin, I got it right?
Narasin. Like Narasin with an N.
Narasin. Ben Narasin has a unique view on this, which is, while most people, and even myself, have said, hey, 7 out of 10 startups fail, 8 out of 10, you're going to make it off the bulk of your wins, Ben's position has always been, hey, why don't you try to beat that average? I think this is a great place to start. Let's talk about, Ben, your track record. How many companies have you invested in? How many have made it to that Series A? And why is making it to a Series A after an early stage investment such a chip and such an important milestone? And welcome to the program.
Thank you. So, I'm a little behind you. I've only got 3 unicorns. Now I'm really upset because I was really proud of the 3, and now I'm like, I've done nothing.
It's pretty unprecedented to have 3, too. Let's be honest. That puts you in the top 25.
Although you did 160 investments.
150.
I only did 80.
So we're probably actually on the per capita the same.
Right, so there.
But then again, my 6 came in the first 100 investments. But anyway, we'll put all these statistics aside because we're basically both proof points that investing methodically and with a theory could increase the number of unicorns per 100.
Yeah. I mean, the biggest challenge I see in angel, I always considered myself an institutional seed investor. I've made one investment that I consider an angel investment in my life, and that was the very first one I made about 11 years ago. And I didn't like being an angel in the sense that I didn't like being a passive investor who put a teeny tiny check in. And so I took the approach of, not that my checks are that much bigger, but just treating it as an institutional process. And so part of that was that for 8 years, I ran a platform where I was making seed investments on behalf of a big venture debt shop, about a $3 billion deployed venture debt shop. And I made 80 investments, and half of them, actually slightly more than half of them, went on to raise Series A. Now, that was important for multiple reasons. It was important to the firm because they wanted that currency. It was important to me because I wanted to believe I was betting in companies that could be truly enormous. I have this view of venture that venture doesn't fund good businesses. Venture doesn't fund great businesses. Venture was put here to fund fucking phenomenal businesses. And so if you can find opportunities that have that possibility, they will have a high likelihood of being able to raise venture capital if they prove their thesis. And raising angel or seed or both is about not building a company, but proving a thesis. Because once you prove that thesis, you can raise enough money to build a business. You can't build a business on the kind of money that is raised in angel and seed. You can build the beginnings of a business. So when I look at the track record of 50% conversion, I like that a lot because it shows that my decision-making process was aligned with my goals of finding a certain type of business. Now, out of that group, one IPO, Lending Club, and, about $2.5 billion of exits, and lots of companies are just doing an excellent job. But I don't like, the one place that I think people have made a lot of mistakes is to assume that the only model for investing as an angel or a seed investor is the model that Ron Conway in many ways originated. It's done very well for him.
Right. And they call that model
spray and pray.
Right.
It's
spray a bunch of bullets around and pray that one hits a target.
And that is just a challenging way to live your life. First of all, I don't think the data supports it. I've gotten access to data that I probably shouldn't have had. And if you were able to get that same access, you would see that barring one or two very specific things that happened, that approach was horrific.
If he hadn't gotten the Facebook shares,
Right.
it would have been a negative returning portfolio. And if he hadn't had the Google shares, it would have been negative returning. And he barely had any investment in Facebook.
Exactly.
So,
And even more importantly, think about that timing. So this is the problem. People generally know that, but they say to themselves, well, as long as I get that, I'll be fine. Excuse me, this goes nowhere where anybody's going to care if I curse, right?
Right.
No fucking way are you getting Facebook in the Series A.
Right.
If the most influential angel/seed investor in the world at the time, who was super connected, got this much
being the tiniest sliver.
right, you're getting none.
Right.
And so when you get none, your life looks pretty bad.
The whole portfolio methodology breaks down. And this is what's very interesting. There was only, before you and I, there was Esther Dyson, Ron Conway, maybe Chris Sacca, and a very small number of people who tried to institutionalize and, let's just say, professionalize, have a thesis about angel investing. So spray and pray is one. Yours is, hey, let's try to find the companies that can be so fantastic, not good, not great, fantastic, just incredible outliers, that they would qualify for a Series A. Because if they qualify for a Series A, you're basically saying, hey, we're halfway there to an exit, or whatever it is, a third of the way to an exit.
You've made a meaningful step.
A meaningful step.
Because it's a long journey. I think the other thing that people underestimate, so it doesn't matter what strategy you have as long as you follow that strategy and that strategy is realistic. I mean, there's lots of different ways to play lots of different games.
Right.
I'm not a golfer, but there's a guy who has what's called a natural golf swing that apparently is awesome, but everybody laughs at him because he looks so stupid because the way it's done is different from everybody else. But as long as he's consistent, he plays a really good game.
Right.
So it's, I wanted to think of it as, when I was doing seed investing exclusively before I became a partner in a traditional venture firm and moved on to doing primarily Series A and B, I thought of, and I still think of, seed investing as my Series A. I wanted to do the work. My attitude was, I can't make a decision to say yes to you in one meeting. I can make a decision to say no. Or I can say, I'd like to spend more time with you. And it'll take me typically about 3 meetings to get to the point where I'm comfortable enough. Because while I want businesses that can be huge, they have to be built by phenomenal people. I have this pithy little saying that I need 5 things to make an investment. People, 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 a great idea in a huge market if it works.
Right.
I need them all. Right. I've played the game of just betting on the people.
How does that work for you? Because that's kind of my game.
That's harder. The problem is when I've done it, a Series A investor can do that. When you're a seed investor, you have to depend on, here's what's been a problem for me. I've been so enamored of the people that even when I was unhappy with the idea and the size of market, I went ahead and took the shot.
Right.
That has not worked because that means you have to depend on them to fail in a crappy idea and pivot into a good one.
Quickly.
Right. And pivots are enormously dangerous and usually don't work.
Right.
And everybody looks back to Twitter and says, but, it's the exception that proves the rule. There's 19,000 companies seeded a year. There's 1,900 venture rounds done a year, of which many are not the 10% of the 19,000. It's the follow-on rounds, the Bs, the Cs, the Ds, the growth. So, if you got 19,000 companies a year and you can tell me about Twitter and 2 others that pivoted over the last decade,
right.
Tell
it's
me
confirmation bias.
Yeah, it's a
people just remember the
dangerous thing.
Yeah. So when you look at people, let's talk about that because you did say that's 3 of the 5, so it's 60% of your decision making.
Yep.
What have you seen in signaling? What type of people lead to this fantastic, extreme success that you talk about? Not good success, not great success, but fantastic success. What did those people? And I think you were also in Dropcam, which did very well. Zenefits and Lending Club obviously had a huge IPO.
Telepart. There's been some.
What did those founders have in common? What is the DNA that you see? Are there tells that you have found over the years?
It's funny. If I could do one thing to figure out whether I'm making the right decision about a human being, in the old days I used to do CrossFit. I would just take them to one CrossFit class and see if they could make it through. Because it's really flipping hard. Yeah. The only secret to entrepreneurial success, in my opinion, is tenacity. If you are willing to give up ever, you will fail. Because entrepreneurship is so ridiculously hard. Yeah. And everybody hears the glorious stories. They read the nice things that come out afterwards. They see TechCrunch. What they don't see is the time when every single founder at some point has stared into the valley of death and had to figure out how to take from inside them something that gets them through that darkness. Right. So if I don't believe you are that person, that is a pass. Now, I'm saying that you mentioned something about how this is the better casino, and you're absolutely right. We live in Shangri-La, we live in Florence during the Renaissance, whatever analogy you want to use, Rome in its heyday, and it's a magnet for the best people. So I go in assuming genius level intelligence almost every time. I mean, the very weird thing about Silicon Valley is it's only happened to me once, but someone pitched me. And I see 1,000 companies a year. I've been doing this for 10 years. Only once did someone ever walk in where I thought to myself, gosh, I just don't know if this guy's smart enough to get it done.
Like, this guy's stupid. Yeah.
Pretty close.
Yeah.
Yeah. So I look backwards at how he got through my door, and it was one of the very few times I took a cold transient over the LinkedIn scenario. And I was like, oh, because normally by the time anybody gets to you, there's at least some level of filtering for whoever referred it to you.
Right. You referred somebody to me last week, and I'm going to meet with them. I sent somebody to you. You come to my incubator. There's some filtering process, and usually it's a multi-level filtering process. People come to us and say, oh, I have Esther Dyson, I have Bannister, Ben, whoever, and here we are. So it's very hard for somebody to not have that quality of intelligence, but resilience.
Yeah, that's
is where you.
So when you're on the, this is the one thing I have challenges. You've been very successful with syndicates, and I'm envious. I have just started to look at that. I did one, the very first one last week.
Oh, great.
Yeah, so totally new experience for me.
You were in a syndicate, or you syndicated a deal?
No, I have made one investment in a syndicate just because I couldn't get the ownership I wanted directly.
Got it.
But that was immaterial. I can't really, as a direct investor, do that. But I created a syndicate for the first time ever.
Oh, wow. Did you use AngelList, or you're a lawyer?
Yeah, I used AngelList and just trying it out because I think they've evolved in a way that's positive.
Yeah.
The thing that worries me a bit about syndicates is, or the thing I guess I would point out is, since the person on the other side of the screen is not meeting the individual entrepreneur,
yes,
they have to have high confidence in you and me or whoever.
Correct.
Because, like I saw an entrepreneur yesterday at TechCrunch that someone had introduced me to quite a while ago, and we tried to meet, but we couldn't. He was in LA. And I said, I'm really sorry we haven't met till now, but I just don't do phone calls. I've got to do a face-to-face meeting.
Right.
Nothing I'm going to learn about you is going to come over. Now, I might use a phone call as a filter, but I need that time with you.
Right.
And if I don't have that, I can't get to a decision. And so I think having the right advocate for entrepreneurs is really important for syndicates and other methodologies, because you've got to have somebody that both can tell the story appropriately and also that the investor on the other side can look at and say, is this person able to make a judgment? Because otherwise you truly do go back to, it's one thing if you're walking into a casino to play poker, a game of skill, where you will beat me over time in poker. I don't play enough. You're a better player than I am. But if we both walk up to the roulette table,
Yeah, 26 and 27 have an equal chance.
Sucker bet.
Exactly.
So I'd rather Seed and Angel be about poker and not be about roulette. And the problem, in my opinion, going back to the sort of spray and pray model, is that is not just roulette. That's a 19,000 slot wheel.
Right.
And you're just putting down a ball.
Right.
If you decide that you just see what you can do. And negative selection bias is going to be hugely problematic, because the best deal is this one syndicate I did. I'm the only outside investor other than a major venture firm that's putting in $7.5 million. So, were it not for my relationship with that entrepreneur, I'm not saying it'll be the right. And how do you, if you're getting access, it's not that it's not a great deal. It's that, let's face it, there's sort of a slight moral hazard in that, well, I can always give it a shot. It's not my money.
Right.
And that's dangerous.
Yeah. So I'll give two rebuttals to that, since I've done more, I think, angel syndicates than any individual syndicate. One, low bet size, right? So you're putting in a low bet size, $1,000, $5,000, and a great way to learn. And I actually encourage people to do their own diligence. And in order to do this, I say, here are the reasons why, here are the risk factors from my perspective, from the founder's perspective, and here is the phone number, the mobile phone number of the founder and their email.
Wow.
And here is the webcast where you can meet with the founder and ask questions directly. And I'm not going to be on that call, so that the questions don't come to me. It's forcing the person to talk to the founder. And I did that mainly because I want people to think about their bets and to learn and to play their hands, as opposed to actually one of the ways I think AngelList is probably a mistake. I think in the long term, AngelList is no longer letting people join individual syndicates who are new investors. They're pushing them to funds and saying, invest in Ben's next 10 deals. And then that gives you the ability to have a chip stack to do 10 things. But then that really obscurifies all decision making, right? I like to force people to make decisions. So I understand why AngelList is doing that, but I love people actually doing some hard work and placing $1,000 bet but taking it as seriously as a $100,000 one.
Well, this goes back to why people can have different rules for how they play the game,
right,
as long as they play their game. Right. You and I are polar opposites, but you've had awesome returns, and I would argue I've also had pretty damn good results.
Yeah.
I'm, just like the examples you're giving are perfect for your model, and they are, when I say we're polar opposites, typically when I'm going to do a syndicate, if I'm going to continue to do them, it's where I am filling out a round that's probably raising an A with a tier 1 firm, and I am adding to my own personal investment in a not immaterial amount. So if I'm putting in 50, I'm adding 250 if I can through a syndicate. And I am going to be aggressive about protecting the entrepreneur from ever talking to anybody.
Right.
But I'm also planning on doing 1 or 2 deals, a whatever.
Yeah.
So they're both highly logical. And you see this in lots of, people can take totally different approaches to businesses and 2 can win that are black and white. There's not a right. There's what is critical is that it has to be demonstrable that the returns are there to be achieved. And so, I was talking to LPs when we were raising the last fund of the fund I was involved in, and one of them said, so you want me to judge you on your past? You want me to believe that past performance is an indicator of future results? And I said, yes, I do.
Yeah, of course.
10 years of funding PowerPoint slides that have turned into everything from IPOs to meaningful exits. I'm not saying I'm always right.
Right.
And it's just, I have a methodology that seems to be doing well. And unless I decide to change the things I do well, I want to learn the things I do poorly.
Right.
When you see stuff I'm doing that's stupid, I'd always hope everybody will tell me, Ben, that's idiotic. That is stupid. You don't know that you use the word XYZ 17 times in a sentence. You really look like a moron.
Right.
But if I'm doing it well, hopefully that stuff I just keep doing. And
and also being considered, like actually having a thesis, executing it, and then looking back on it, which is something I've done in writing the book and then, talking to new LPs who want to fund me. I think actually doing some predictions, writing deal memos, assessing your past performance, that is one of the skills. It's just called being considered. When you lose a hand in poker, replaying the hand in your mind and saying, what did I miss, right? And even when you're in that final river bet, and the person shoves all in, I always stop and say, okay, let me go back to the first moments of this hand. What happened pre-flop? Who folded? Who wanted to see the flop? Okay, how many aces could they have had when the board didn't come up with any aces, but they were willing to take this $400 bet to see the flop? Maybe there was 1 or 2 aces that got burned. Yep. So this idea of replaying the hand and figuring it out.
There's a term for this in the military. It's the after-action report.
Uh-huh.
And it is, I think it's one of the, look, I spent 10 years getting to know 303 VCs. And I have pretty strong opinions on which of them are good and which of them are not. And I notice these patterns and habits. And one of the things that I always find is a dangerous weakness is those people that don't want to look to their failures and understand them.
Right.
To me, you learn a lot more from your failures than you do from your successes.
For sure.
Luck is required. There's no doubt about it. Luck is the combination of hard work meeting opportunity and timing, and it's a nice little stew. And if you're lazy, you're not going to get lucky.
Right.
But it's when you look back on the things that went wrong, one of my partners in the old days said something to me I really liked. He said, "Look, the outcome of the decision does not necessarily indicate the quality of the decision you made."
The outcome of the decision. Right, you could lose with aces, you could lose with a flop straight because somebody hit runner, flush.
Exactly.
But that doesn't mean you made the wrong decision.
Right.
It just means you got unlucky.
Remember when Moneymaker won against Ferguson?
Yeah.
Ferguson absolutely, positively made the right call every single time, but he lost all his money. Right. But it doesn't matter because you play that hand 1,000,000 times, you never fold it.
Right.
And so when you look at decisions, so think about Friendster v. Facebook. Mm-hmm. Did Benchmark or Kleiner make a mistake investing in Friendster? I would argue no. At the time, where they were, the trajectory, the growth, everything was just glorious. Now, maybe they made a mistake pushing the founder out. That's a different argument. But, at the time, the decision to make that investment, man, I would have been envious that they got in.
Of course.
But you see that it didn't work out. They lost all their money. So there's having that after-action report, having that analysis. One VC I talked to, because I always, for the 2 years I was a general partner, I would ask every friend I knew that was a partner, what's the thing you've learned that you wish you knew when you'd started? What's the thing I can do to be a better partner to my partners and help them be a better partner to me?
What was that for you? If you look back now on these investments.
Oh, I wasn't asking about the investments. I was asking about partner dynamics.
Got it.
That's a very different thing.
Right.
On investments,
Well, let's answer both. That's interesting. What do you think the mistakes people make on partner dynamics are? What have you heard when you've asked that question without revealing the person who answered it? What are the answers you've gotten?
the best answer I got was from a guy that's very senior, runs a fund that currently raises about $1 billion at a time, and he said his best learning was the need to parallel his pace, the deal pace, and his partner's decision pace, and how hard that was. And that was an eye-opening moment for me, because I have this methodology where I sort of think of it as I'll spend 40 days in the desert, but once I find that burning bush, I just take the tablet home, I know I'm mixing metaphors, and say, here are the 10 commandments.
Right.
And then I expect everybody to at least understand what I'm talking about. But the reality in venture is, you take that tablet in, they got 75 questions.
Right.
Like, why
Let's
isn't
go
there
over
an
number
11?
4 again. Yeah.
Shouldn't it be 12?
Yeah.
And then you got the squirrel issue, which is just like, wait, what kind of stone is that? Can you really quarry that stone continuously? It's like, because we're going to have to hand out a lot of these tablets. It's like, no. There's a lot of interesting things about venture. But that was an eye-opening one, because I realized my process was to spend all the time and energy to get to conviction myself. And I'm so hard on myself to get to that answer, I didn't expect to then have it be hard on me thereafter.
Right. Yeah, because one of the dynamics of venture firms and the real difference between seed investors and angels and venture firms, I would say on a practical basis, consensus building just doesn't exist in angel investing. It's a consensus of, do you feel this company is one that you want to try to help grow and that you want to be involved with, you want to have your name on, fits your criteria, fits your thesis, is going to have a return. You have to take all of that information and say, when I present this to my partners, are they going to go for it or not?
Yeah.
And did I go for it or not in their last deal? Did I shoot down their last deal? Was I too negative, or am I not being negative enough?
That's a huge danger. That's a weakness.
It's a weakness in the system. It's a flaw.
Absolutely. Somebody said to me once, the more people involved in a decision, the worse the decision becomes. And I'm not sure if that's true. I think
there is an optimal number.
So here's the challenge. Sometimes one person's opinion is enough.
Right.
The analogy I love is, there's a very famous bourbon called Pappy Van Winkle.
Of course.
Right?
Yeah.
Now, in most
Drinking it
whiskey
the other
businesses,
night. Thanks, David Sachs.
We should have been doing that. Well, you'll bring that when I do dessert
wine. It was
wine.
in 1976 or something. It's incredible.
It was probably 23-year-old, because I don't know if they vintage date it. But if you bring bourbon,
it was really old. It was unbelievable. It was from the 70s.
So Pappy is different than almost every other whiskey. Every other whiskey, they have a tasting panel. They have a group of people that taste through and makes a decision. Pappy has one guy,
right?
The original guy. And his attitude is, if it's good enough for me, it's good enough for the people that want to drink my product.
Right.
And he is really fucking good.
Right.
So I think that if it's the right guy or gal, one person's opinion is enough. The problem...
There's not too many of those people.
Yes.
Not too many Steve Jobs.
And how many of them put the time in to make sure their confidence in their own decision is there? The biggest... I don't know if it's an insult, but the one thing, when I'm coaching entrepreneurs, I've helped almost all the entrepreneurs that have raised, I've spent time with during the raise. It's a very common thing for me to make introductions, to help entrepreneurs raise, to give them feedback on their round, to go through term sheets with them. I mean, I do this a lot, and it's very time consuming, but it's enjoyable because it helps them get to a better outcome. And one of the things I'll often say when they ask me about certain people, that I tell them in advance is a huge warning sign, is that person doesn't have the strength of his own convictions. That is the most dangerous person in venture in several ways. It's dangerous to the person, and it's dangerous to the entrepreneurs. Because when the person wants to do the deal but isn't strong-willed enough to believe in their own vision. And this is true for entrepreneurs too. So when I was an entrepreneur from age 12 to age 37, and when you're a young entrepreneur, people give you lots of compliments. Oh, you're so smart. Oh, blah, blah, blah. And I'm always like, I'm just another guy, dude.
Yeah.
And one day I read something by Ralph Waldo Emerson. I've read maybe 5 pages of Emerson, by the way, but this struck a chord. It was, I'm going to paraphrase, when you believe that what is true for you in your heart of hearts is true for all men, that is genius.
Right.
I would argue when it is really, when you believe what's true for you in your heart of hearts will become true for all men, that is genius.
Right.
And it was a moment when I realized I am different. In lots of ways, some good, some bad. And if you can see something others don't see and you have the conviction, that is what can make a great entrepreneur and can make a great investor.
And can change the world.
Absolutely.
Right? You see something others don't, and you're willing to pursue it with all your zeal and effort and not give up, as you said before, with the resiliency and the ability to keep...
versus hanging out and quarterbacking on the sidelines. It's... I'll give you one last quote in terms of something someone told, well, actually more than one person told me, but this is my favorite of all. We've figured out that it's about conviction, not consensus. both Dick Kramlich, who started NEA, and I think it was David Z, who was very senior at Greylock, said the same thing in different words. They're the deals we should obviously do. There's the deals we obviously shouldn't. We make all our money on the ones in the middle.
Right.
The contentious ones, the ones with the long conversations.
Sure.
And later, everybody believes they were easy. They believe it was obvious.
Yeah.
And they are wrong. You look at the deal notes, and it was this. You go back, I know many, many deals where very famous people did really great deals that did extremely well. And they have told me, all my partners tell me how easy it was. I was there, Ben.
Yeah.
It was fucking hard.
We could not get consensus around Google or YouTube or Tesla or whatever it is.
Yeah.
I mean, that famously, the Tesla investors tried to push Elon to just make drivetrain technology and battery packs for other automakers. Can you imagine if there were no Tesla cars, we would not have made any progress. What would the impetus be for BMW or Volvo? I think Volvo said they're going to go all EV.
Yeah.
Like, there's no impetus for Volvo or other people to go all EV or have an EV in market if it's not for Tesla's performance in putting those products in the market.
Yeah. Visionary entrepreneurs can die a grisly death.
Right.
But the ones that survive, when I talk to entrepreneurs with their fundraising, particularly at the seed level, I always tell them the same thing. It's like, no matter what, an investor, a venture investor or an institutional seed investor, an angel investor, is building an army. I want my army to be the Israeli army.
Right.
The most elite fighting force in the world. They can win a war against 3 countries that surround them that hate their guts and want them to die.
Yeah.
My fear in most angel investing strategies that I've seen that aren't as thoughtful as yours is it's the Russian army. Here's 100,000 guys with pitchfork with a stick going against guys with guns.
Right.
But regardless of what type of army you build, as an investor, you don't need all those people to come home. You need them to take the hill.
Right.
And the challenge with that is for an entrepreneur is you have to understand you're part of my portfolio. I will do everything. I will bleed your blood myself to help. But at the end of the day, I need certain types of, I need public companies in my portfolio.
Right.
And that means you are all trying to take the hill.
Right.
And some of you aren't going to come home.
Right. And this is the challenge. We both started our first 20 years of our career or so or more as entrepreneurs and then went into investing. So before we get into the portfolio review, what is a better life? Which do you enjoy better? Being the CEO and the visionary and living or dying with one, act of bravery in this going up the hill metaphor, or do you like being the general and leading the group of 100 people to take the hill? You sleep better at night? Do you miss it? And and what have you learned from each?
It's funny because I ask a lot of my friends that question too. It's a hard one to give an answer to. It's both
existential, yeah.
Yeah, I think the best investors always miss it. I think So I will be an entrepreneur till the day I die. Right. I just live vicariously through many other entrepreneurs. And in fairness, I'm not the general. I don't get to lead. I get to give whatever aid I can. I'm a retired soldier who's taken a lot of bullets to the chest, who wants to coach my warriors on how not to.
Right.
I will tell you for many, many years, I would struggle with this one idea I really wanted to start, or I'd see a founder and I'd be like, I want to quit and join him. I actually tried to convince that guy I mentioned, not by name, that runs the fund that's about $1 billion every time. I had an idea 7 years ago. I wanted to, after Lehman failed, to create the equivalent of Bitcoin, but backed by gold. I wanted a digital currency backed by actual gold that we held in vaults. And he had a deep history at PayPal and Wells Fargo, and so I went to him and said, quit your job and be my guy. Right. And he laughed out loud. Now, at the time, I didn't realize just how lucrative being a venture capitalist is. These guys can make a lot of money before carry ever kicks in. But, there was always that tug. And there still is from time to time. But I've become at peace with the fact that I really love the multiplicity of businesses I can be exposed to. Because, when I sit down with an entrepreneur that's in one business and the next day in the next and another and another and another, it's constant brain refresh. Hearing 1,000 pitches a year gives me new ideas, not all of which I like, obviously, because I only fund a tiny percentage of them. Working with entrepreneurs, and I just funded a company in the aqua farming space. I never would have thought of that category.
Aqua farming, what's that?
Growing fish and shrimp to sell to humans because we don't have enough protein in the world.
Amazing.
Yeah, and I almost didn't take that meeting, but this is a very compelling entrepreneur. It's a very big business. Being an investor is continuing education for me. And I'm a freelance food and wine writer as well, and I write about all kinds of things, and that was that part of me as well. But I've started to push that to the side because going in and digging in. I have an investment in a company that's in the trucking space. Did I know anything about trucking before I got into that business? No. Compelling entrepreneur, great business opportunity, huge market that has been untouched by technology.
It's almost like being an investor in this stage is like getting to parallel CEO or parallel management team, 30 great ideas, 40 great ideas, plus just hear all of these people tell you their science fiction version of the future.
Yeah.
And it's like, wow, the meetings we take and the thrill we get from them. I tell people, like, if this was an hourly job with no upside, I think I would pick it. Like, literally we just got paid a salary and it was just like a government job, but your government job was called Fund Future Enterprise, government, .org, .gov. Yeah. And we just sat there and punched a clock and we're like, okay, which one do we give this allocation to change the future? What an amazing job it is just to hear how the future is, going to manifest itself.
Although there can be times. So, when I was doing seed investing exclusively, I would absolutely see at least 1,000 opportunities a year, and I would fund 7 to 10. As a GP in a venture firm, I actually funded 1.5 over a year. I totally agree with you. I will not underestimate, though, that when you go 5 months, I remember going 5 months as a seed investor without seeing a single thing I wanted to invest, you start to get to the point of like, good God, man, isn't there anything exciting out there?
You know what it is? It's tourist season. What happens is, I'm going to guess this happened during the peak of like some Facebook movie or Uber on demand, peak. But I find that when you start seeing 17 versions of the same idea and the person presenting it is not indefatigable and resilient, and the second this gets hard, they're going to pull the ripcord and just bail. They're literally going to get on the first boat out of Dunkirk and say, do not take me back.
The guy trying to climb up the side.
He's just like, get me out of here. This is not for me. That's
entrepreneurs.
Entrepreneurs, we used to call them, now I just call it tourist season, because it's like in New York City when you're trying to walk around during Christmas, you're like, I cannot go near Rockefeller Center because all these idiots are coming in to see a tree.
It's so frustrating because you're trying to move and they're like,
it's like one tree. It's like, by the way, there are thousands of trees in Central Park. This one tree with a couple of colored lights on it, you're literally going to park on the West Side Highway, walk through traffic. I mean, it's insanity.
It is a very pretty tree. I like to see it, but when my office was on 57th and Madison, I would wait till about 10:30, 11:30 at night to go home.
Go at midnight.
Nobody around.
Perfect.
That's the best.
Perfect.
All these people that are moving so slow.
And then they all want to get on not Woolman Rink. They want to get on that little rink. And the rink is the size of a backyard above ground swimming pool. Yeah. And you get on it for 15 minutes, crash into 3 people. It's horrific.
Better to watch.
Much better to watch. All right, listen, when we get back from this quick break, Ben is going to go through his portfolio review with me. We're going to go over his top 3 or 4 wins, how he sourced them, and how they did, when he knew they were going to be big wins, and then also go through some of the crushing losses and what he learned from them when we get back on Angel, the podcast. Ah, yes, Audible. I love Audible because it makes me smarter, and Audible is, of course, the leading provider of audiobooks and spoken word audio products. Their content is unmatched in the world. Their selection of audiobooks is tremendous, and you can access those books anywhere. Yes, that's right. iPhones, iPad, Android, Windows, your desktop, wherever you are, you can get your Audible, and the app has tons of great features. One of the great features that people may or may not know about is that you can very easily put it on sleep mode. So when I go to sleep at night, I put my earbuds in, Apple's earbuds, I put them in. My wife wants complete quiet, so she's sleeping. I like to go to bed, 30 minutes of an audiobook. I set the timer for 30 minutes, and I drift off to sleep while learning, and it just calms me down when I'm at the end of the night. I love doing that sleep feature. Also, you can speed up. Some authors speak very slowly, and I want them to speak a little bit faster. So I put it at 1.5 so I can consume my content faster. These are some of the great features. The other one I love is when you're listening to an audiobook, you can take a note. Additionally, when you're listening to audiobooks, they now have a killer feature, which is there's a little car icon. I'm looking at it right now, and I just noticed it in the app. And I don't know if they've talked about it, but they have car mode, where you click on the car icon and it gives you a nice, big, easy rewind 30 seconds. You ever have that moment where you're like, that person said something brilliant in this audiobook? Well, with Audible, you just hit that one big, huge 30-second rewind button, and you get to reinforce that learning And if you were daydreaming and missed it, you can just go boop. And a lot of times I'll hear something interesting. I said, let me just go back and hear that one more time so I get it. And then you can hit a plus, a bookmark. And what I'll do is, if I'm in a situation where I want to take a note, I hit Siri, I hit the audio to text, and I write my note. So I just speak my note, save it into the app. It pauses the book while I'm writing the note, then I save it. Or I can hit play and take notes while I'm listening to the book in the Audible app. It also keeps your place, so if you're using your iPad or your iPhone or your desktop, it'll keep that synced. Chapter navigation is super easy. Speed control we talked about. You can even share a book from your library by using Send This Book. They also have channels. This is a new thing that's been around for just a little bit, where they have exclusive content, original short stories, comedy, best of news, podcasts, all that kind of stuff. And if you don't like a book, you can easily return it, get an exchange, no questions asked. They have this listener guarantee, which, I haven't taken advantage of because books are so affordable that I have even thought, I don't even want to return it because I want the author, even though I didn't finish it and care for it, I want them to get a little bit of cheddar out of it. But maybe I should. Maybe I should do that. I'm just thinking about it right now. So here's our special offer just for our audience. Get a free audio book at audible.com/angelbook. Audible.com/angelbook. You'll get a 30-day free trial membership. And my book of the week, I'm looking at two different books that I listened to recently. One is The Inevitable by Kevin Kelly, who was just on This Week in Startups, and he is tremendous, and the book is great. It's an amazing framework for how to think about the future of technology and where the opportunities are. But another book that I've seen all over the place is The Subtle Art of Not Giving an F, UCK. And this book by Mark Manson, I don't know who this person is, but it's a pretty interesting book because it does drift into some Tim Ferriss territory, some entrepreneur territory, but it really explains how you can craft a life without all this anxiety that people have. So it's kind of a hodgepodge of different ideas, but I actually didn't think I was going to like it, and it actually turned out I did like The Subtle Art of Not Giving an F. It's a pretty charged title, but I think the book is actually pretty good. I think you're going to get some good things out of it. So those are my two choices, The Subtle Art of Not Giving an F and Kevin Kelly's The Inevitable. That being said, I just downloaded Anti-Fragile by Nassim Nicholas Taleb or Taleb. I can't remember how to pronounce his name, but he's the person who wrote Black Swan. Somebody who read my book, Angel, told me I need to read his book, Anti-Fragile, because it has a lot to do with my betting and gambling strategies. So if you haven't listened to Angel, my book, that's another recommendation. Go ahead and buy that. I actually speak the audio on that book, and we have some great episodes of Angel, the podcast, at the end of that, where I do some original content. So thanks again to my friends at Audible. Go to audible.com/angelbook and get your 30-day free trial membership. Audible.com/angelbook. Audible.com/angelbook. I love you, Audible. Thank you so much for sponsoring independent media like Angel, the podcast, and This Week in Startups, which you guys and gals over there have been supporting for so long. I truly appreciate it. And congratulations on just keep iterating on the product. Every time I open that app, I find new features I love to go along with the great content library I've built over the years. So thank you again to my friends at Audible for all the support. Let's get back to this amazing episode. Hey everybody, welcome back to Angel, the podcast companion to Angel the Book. AngelTheBook.com, over 200 reviews, 5-star. Thank you so much for that. If you ever want to do me a favor for creating all this great free content, there's one thing you can do. You can either rate this podcast or write a review of the book on Goodreads, Barnes & Noble, iBook, Goodreads, whatever, Amazon, whichever one you prefer. If you ever want to get in touch with me, Jason at Calacanis.com, and I'm Jason on Twitter. Ben Narasin.
Like Harrison, just like Harrison, but with an N.
Narasin, like Harrison.
It's a
Ben
fake
Narasin.
name. Somebody changed it when people came over once.
Yeah. What was it before? Do you know? Remember?
No idea. My grandmother was senile by the time my father asked her for our original name.
Yeah. Mine was Calacanis, with K's, which means done well, or to have done well in Greek. But they were like, Ellis Island was like, Calacanis, get your ass in there. And they were like, but my name's spelled with K. So we're like, you're lucky to be here. Keep moving.
Right. Move on. We don't have time for that.
Let's go, man. There's a line here. Welcome to New York, kid. All right. So Ben is an investor in how many companies? 80?
About 80 over the last decade.
80, and 3 of them in the Unicorn Club. And 25 years as an entrepreneur, 8 years as a seed investor, very similar to myself. In fact, almost identical. And what are you doing now? What is you were investing other people's money and your own?
So 8 years as a seed investor, where I had the right to invest my own money. Then 2 years as a general partner at a venture firm, and now having left that firm because I realized, actually, it's an interesting point. I didn't join that firm to do seed investing. I joined to do A and B. Right. I felt like it was my graduation, moving from high school to college. But over the last 2 years, it has become very obvious to me for very specific reasons that in order for me to be a world-class Series A investor, if that's what's going to happen going forward, I need to do seed as well. The landscape has changed dramatically. It's a great question. I don't think that many people have noticed it either. There's
I have, but I
think you have. You have.
I want to hear your version of it because it's good confirmation for me.
Part of it is the tier 1 seed investors of today are the tier 1 Series A investors of yesterday. Explain
why that happened, or how it happened.
They're finding the best. So part of it is that just everything has moved earlier. Mm-hmm. One of the analogies I used to use was that Series A in the old days was the Olympics, and now it's CrossFit. In the old days, the best countries in the world, Germany sent their runners that already won a race to compete. So the top guy at Cisco or gal at Cisco went, started a company, raised a bunch of money on a concept. That was a classic Series A. Already proved themselves, now had an idea.
Yes, this is let's say 1990 to 2005 era.
Yes. But then all of a sudden seed comes along and you can raise $1 million pretty easily, relatively speaking, if you're phenomenal, you've got tenacity, you've got great ideas, et cetera, et cetera.
Good prototype.
Easy's not really true, but you can raise it a hell of a lot easier. I'll tell you what, I gave up 20% of my company for $100,000. Right. A company that I then took public with no venture. So it's a different world now. When people whine about their valuations, it's like, good for you. But what happened was the CrossFit model is if you want to compete at the CrossFit Games, there's a regional series where you can do push-ups in front of a webcam. And if you're faster than anybody else, you get to go to the games. So Seed created this massive audience. I think that something like 19,000 people went to the various competitions in CrossFit. And then in the end, there was 40. That's what's happening. 19,000 people show that they can do something with no prior experience proving themselves as Olympians. Right. And 40 of them make it to the games.
It's an open field.
It's an absolute open field. The volume is so much greater that you are going to have superstars show up. Right. So instead of whatever the ratio was before, 100 people of which 10 make it that have already raised venture, now you've got 20,000 people of which 100 make it.
Right.
So that changed. But here's the reason it's becoming so important, at least in my view, for venture to do seed well, which they have not done historically.
Right. It's an afterthought.
They put in their money, not their time. I wrote a whole piece on this for TechCrunch. It's just a really hard thing. Today, those Series Seed guys and gals are preempting their own Series A's, bidding against venture firm Series A's, and keeping their people from raising Series A's at all. And they're also gaining undue influence. Now, sometimes that's fine. I know I have undue influence on my entrepreneurs.
You have influence. Now, let's take the undue out of it. Undue in whose position?
But undue is okay as long as it's appropriate.
Okay.
So when I say undue influence, it means that when I give my entrepreneurs guidance, it is highly likely in most cases that they are going to listen to me and trust me.
Right.
Now,
I would call it earned influence.
Okay, that's fair.
Yeah.
But I'm an honest agent. I haven't lied since I was a teenager.
Right.
Even if it's not in my best interest, I am going to be blunt about the reality for that entrepreneur. What I've discovered is that just ain't the way it works for most people. And I have watched seed investors influence entrepreneurs to make very bad decisions because it benefited the seed investors. And so the way I look at it is there's a couple of things. One, some of the best deals will never see the light of day for Series A because they'll get doubled down on, and a lot more than that. By the way, I have an entrepreneur that was offered $20 million for their Series A by an outside party, and my co-investor, who's a very famous institutional seed firm, trumped it and led a $20 million round. Most VCs think it's like a $2 million double down, and a lot of times it is. $20 million from a seed fund
How?
is ridiculous. SPVs. Everybody, you know how much money there is for SPVs right now?
Yeah. Explain what an SPV is to the audience.
The special purpose vehicle is where you've got an outside source of capital that wants to be involved with you and they don't have a direct relationship. So here's one of the things that happen. All the top seed folks, and that's a small list,
Right.
succeeded really well relatively early. Their first fund was hard to raise, so they were loyal to those people. After that, it's highly likely that, one, they're not taking any new LPs, and two, all their LPs want to give them more money. But in order to be efficient as an investor, you have to have an appropriate sized fund. Because if I'm able to deploy $100 million as an individual, great. I don't know if I am. In every 3 years, let's say that's a typical term of a fund. If you give me 200, why do I have more capacity? If I can lift 1,000 pounds in a deadlift, putting 2,000 on the bar doesn't do anything for me except rip my muscles apart.
Yeah.
So, what happened was they wanted to put more money into these funds, but they didn't have a way to do it. So what they started to say is, what if we double down on those deals you have going forward? You did really well in company X and Y, but then the VCs got all the benefit. Why don't you get the benefit?
Right.
And so instead of turning it over, I think of it as seed is very high quality. I think of myself as Dr. Xavier's School for the Gifted.
Right.
Right? It's still a high school, though.
Right.
And eventually there should be a college for the gifted where you can go on to get a different set of experiences.
Yeah.
Right. And so taking that away from people can be dangerous. Anyway, so when seed investors hold back their very best investments for themselves, I know as a Series A guy, I'm not going to see it. Or when I do and I bid on it, maybe I get trumped by the guy or gal on the inside.
Right.
In addition, I went through an experience.
Is this a good thing? This is a good thing for entrepreneurs, or it's a mixed bag?
I think it has a lot of risk. I think it depends on how it's handled. My biggest fear is there's a bunch of risks. One, I do think graduation is important. I'm not saying that all VCs work hard or are smart or are useful on the board. I mean, there's plenty that aren't. I wrote a story just on that, like separating the rest from the best for TechCrunch. It's like a lot of these people don't deserve the pay they get and can be detrimental to their entrepreneurs. But there are a lot of really good ones.
For sure.
And if you get a really good venture capitalist on your board, they can open doors for you. That brand can help you with hiring. There's so many things that can come from it. And here's the thing. Sometimes, not all the time, but sometimes one person can make the difference between that ultimate outcome and failure. Or in helping you see something you didn't see. Or, it's everybody's dream is to have somebody, at least it is for me, to have somebody on their board that makes them better. That rises them up, that helps them see things, that doesn't tell them what to do. That's not a board member's job. I sat on a board once with a guy, a very famous investor, came out of a very famous firm, and the entrepreneur was talking about what he was doing with his budget, and he said, we're going to hire some more engineers, and he said, no, we're not. I remember looking at him like, the fuck do you think you're doing?
Yeah.
It's not your job to tell him what to do. You can give him as much encouragement as you want, but unless you're going to fire the founder, shut the fuck up and talk about how he should think about that decision. And maybe there's this, or maybe, but it isn't. No, you're not going to do that.
You can't just jump over the back seat and grab the steering wheel.
Right. In fact,
at speed.
You're actually not even in the car. You think you are, but what I guess you have is a gun that can shoot out the wheel and kill the driver. I mean, I don't know.
Yeah,
it's like David Hornick has this saying that he used to think that he had, he loves music. So he said, I felt like I was a DJ with this board with all these dials and things, and I could control the entrepreneur. And then one day I looked behind the mixing board and it wasn't plugged in.
Yeah.
I only had the on-off switch. Yeah. So I think the danger is, can the seed investor legitimately help the entrepreneur make the right decision for the entrepreneur and their business without the undue influence in their own mind of their own financial best interest?
Right.
Because here's another example. I've only done this once. Years ago, one of my entrepreneurs had Series A interest from a Tier 1 firm at a certain price. And the lead investor, who I have great respect for and I think is an awesome investor, said, why don't we put in $2 million instead? And I was like, I don't know. I'd rather him have the 6, but I respect you. You're great at this, so sure. So we gave him the 2. 9 months later, they raised a round at exactly the same price they would have if they'd taken the money in the first place.
Wow.
Which means more dilution, which means 9 months of not having any. Look, if you're getting my guidance, you're still going to get it.
Right.
If I give you twice as much money, do you get twice as much guidance?
No.
Right. No. So it's not about quantity. And I do worry about that. But as an investor, I worry about, do I get cut off on access to deal flow? Do I get cut off when I bid? Or, is there just, here's the last point I'll make. There was an investment I was working on, I worked really hard on. I actually spent 3 months on it. Now, you will already know that if I got to spend 3 months on an investment,
you were close.
and it was not the hottest investment on the street. There is no investment that is the one everybody wants that you get to do 3 months of work on.
No.
Period.
The deal would be closed in 3 weeks.
Exactly. Yeah. I bid. It turns out I was the highest bid. I found this out later. In fact, I was a lot higher than the other tier 1 firm that was bidding. But it was a modest down round. Now, that was logical. I wanted to give them a flat round, by the way. I couldn't get my partners there, and in the end, it was all I could do. But I got the entrepreneur there, and the entrepreneur signed my term sheet. And then 3 weeks later, told me over breakfast that they changed their mind and they walked away. And when I went to figure out why, it was because they had 2 seed investors that measure themselves on markups and markups alone.
And
they talked him out of taking $15 million in exchange for taking 2. And you know what they told him? I always tell him, we just give you 2. 6 months from now, you'll be killing it.
Yeah.
They haven't raised the round they wanted to raise yet.
Right.
And it's been over a year.
Yeah. There's a misalignment sometimes with, I think, the early investors who think small. But if you're an early investor who thinks big, you know that getting Benchmark or Sequoia or Social Capital or, pick the individual founders fund, whatever, involved, their names alone are going to elevate the situation, and you might come to a really great outcome, like a really great outcome.
I've helped so many entrepreneurs with hiring. I don't go out and source the hiring, but often if they've got a senior person, they'll say, hey, would you be willing to meet with them? And the answer is always yes. And it's basically my job to show them why this is such a ridiculously great opportunity that they can't possibly say no. Yeah. And they always want to know about the board and the investors and where there's capital and all that. And it's a lot easier when you can say, hey, you know what? This company, Scott Sindell from NEA, who leads that firm, is on the board. They have deeper pockets than anybody on the planet. He's a ridiculously supportive investor. You do not have to worry about support around the board table. It doesn't mean everybody always puts money up. I mean, nobody's going to just, catch a falling knife. But that helps a lot. And I love a lot of the investors out there that do a great job of seed, but there's only so far those brands will go. Yeah. And it gets...
How big do you think these SPVs are going to get? We were talking before the camera started rolling about my syndicate, and we just did in Cafe X $1 million.
Congrats.
$500,000 in Blockable, $250,000 in Underground Cellar. I can talk about these things because they're now closed. And so we've seen a pretty consistent uptick in the amount invested per individual and the amount overall we're able to raise. And we have raised our own threshold in which we will syndicate. In other words, we now only syndicate if the product has come to market and there are other investors. And like you, maybe not the last 20% of a round, but the second half of a round. So with Blockable, we had some great investors in there previously like Khosla and Social, but with... that was Cafe X. With Blockable, we had Vulcan Ventures, Paul Allen, so that was a great way to sort of say, look, there's somebody else great involved here. How big do you think they're going to get? You just started an experiment with them. You've been watching them. What do you think the upper bounds of this will be?
The stage will determine a lot of that. So it's funny. The reason I did my first syndicate was a combination of things. One of them was several of my entrepreneurs encouraging me over the years to do things on AngelList, getting more aggressive about how they encouraged me to do it. But then I also had
They want to participate, don't they? In some cases.
I think it's more that they know me very well. And as an example, one of my entrepreneurs said to me recently when I just left the firm and I was saying, well, I'll either figure out whether I raise a fund or I join a fund, what the right model is. He said, Ben, you shouldn't do either of those things. You should just do deals with syndicate. You have great access, you know all these VCs, you can get into the right deals, you work really hard with your entrepreneur, you reference well, just do the deals on your own, deal by deal. It's so much better for you. Then I had a meeting that was totally unrelated to that, and this sort of gets to your question, where I was talking to a large LP who has a fund that does both direct investing, fund of funds, and other things. And they were asking about my prior portfolio and my prior firm and what was exciting. And I was going off on how much I love this one company. And he said, could we give you $5 million to invest in that and then give you carry on it? And I was like, that's a thing?
Yeah.
But it is a thing.
Right.
And it's a way for outside investors to get access to much later stage. So I think that, in that case, you're going later stage. This is a company that had raised, our most recent round was $45 million, and there was 5 open, which we're going to use for strategics. But could I then say maybe I'm the better source for that capital?
Sure.
Have to think about it. I can't trump the strategics if the strategics can give value, but I think there's other ways that strategics can get involved. So I don't think there's a lot of limits in SPVs. Zenefits back in the day, I mean, I don't think all that, I don't know for absolute certain because I never bothered to read the docs because I wasn't putting more money into the Series C.
Right.
But I don't think you got $500 million on $4.5 billion out of the direct funds that were providing it. I have to believe there was some SPV work inside of that.
Yeah.
And so that makes, family offices, the country wealth funds, these sovereign wealth funds,
Pretty amazing.
Russia, China, the entire sand-based nations.
What's Norway going to do? Did you just see Norway has $1 trillion?
Oh, God, no.
Norway has the largest sovereign wealth fund, $1 trillion. This is the message to the people of Norway. I know a couple of angel investors. Maybe I should come check out the fjords again. I haven't been there in 15 years. I think I got to go over there.
That's good. They should fly us both over, and we can do opposite ends of the spectrum.
Absolutely,
and they can
just
give us
have a little conversation about it. Okay, let's go through the portfolio. Tell us about the biggest miss you ever had. Tell me about the company that you missed investing in and how you blew that investment. You wanted to bet, you had the opportunity to place the bet, you didn't place the bet. So lightning round.
This I don't have.
You don't have the negative portfolio, the anti-portfolio. You didn't pass on Google or YouTube or Facebook or Twitter.
I would have passed on Google because I met one of the founders in the 90s and he tried to steal a CEO that I had hired to run one of my businesses. I thought he was an absolute ass. So if I'd been given the opportunity.
Wait, it was Larry or Sergey?
It was Sergey.
Yeah.
Wait, it was the skinnier one.
Well,
sort of
the
the
skinnier at what
taller
period of time?
Yeah. Well, remember, this was, they had just launched, they weren't even live yet. He told me the name of the company was Google, and I was like, what the fuck does that mean? And I was like, and why isn't Alta Vista good enough? I mean, obviously, I was also ignorant of the fact that this was
What's
a
the
huge
lesson
reality.
from that you wouldn't have been able to
So
see
that's
Google?
the thing I do think about a lot, and it goes like this. I'm not great with arrogant people, and that would
It's
have
just you personally
hurt
don't
me.
like them. You try to be humble yourself? Is that, or is that a projection
depending
thing?
on, I hope I am, but it depends on who you talk to.
Right.
So my attitude is this. In 10 years of investing and 10 years with working with 303 VCs, I've met, the number of assholes I met, I can count on 1 or 2 hands. There's a lot of entrepreneurs that are perceived as arrogant, but sometimes it's just smart and driven. And once they understand that you have the same passions you actually have, and look, I took my company public when I was 30.
Right.
I'm very proud of that. I think that having gone from zero, from an idea in 1993 in the internet space to a public company, shows that I have a similar view of the world as to what they want to achieve. So my point is, people don't stay arrogant as soon as they figure out that you're a kindred soul.
Right.
So it's very rare that I come across true arrogance. What I wonder about is exactly the point on Google. If I couldn't see past that, let's say I never saw beyond the arrogance and therefore passed, wouldn't that have been a tragic mistake? And financially, it obviously would be.
Yes.
And so now, by the way, I have the biggest mistake. I met Jerry and David
of Yahoo.
Jerry
Yang, David.
at Internet World 1 down in Florida. They had a folding table with some flyers on it. I'd heard about Yahoo. It was still in their dorm room. It wasn't even named yet. And I went over and started talking to them. I'd come out of my own business. I had some money. And I said, well, this is really interesting. I don't know how you're going to build a business out of it, but you guys are getting some good buzz. Maybe I should give you some money and then you could, see about how to expand it. And they thought about it. They said, well, we don't know if we want to raise money or not and whether this is really a business. And I said, well, let me take your card and maybe we can talk some more.
Right.
And I was thinking I could give them $250,000, which was all the money I had in the world. And I walked out of that hall. By the way, the hall had 20 companies in it.
Right.
And I thought to myself, what the fuck are you doing? Yeah. It took you 25 years to make this money. You want to give it to 2 kids in California? I ripped up the card and threw it away. That was clearly a mistake.
No gamble, no future.
Yeah, that was...
You were thinking about the downside, not the upside.
And by the way, the lesson I did learn later from Reid Hoffman? At some point, the conversation was around valuations. And he said what he figured out was that when the valuation was too high, the right answer wasn't no, it was less. And so when I invested in Zenefits, I invested in one of Parker's very, very, very first, the pre-Series A round, the valuation was pretty rich. But I thought about that point, and I said, you know what? The answer isn't no, the answer is less.
Less dollar amount.
Less dollar amount.
Yeah.
So, that was
why
a
lose the
helpful
option
learning.
of being along for the ride when you just put less in?
Yeah, I mean, I will tell you this, though. It is maddeningly frustrating when you have an exit that makes you a ridiculous multiple and you look back at how little you put in compared to how much work you did. I can tell you a story without naming a company, although it'll come up in my exits. Maybe you'll guess. But I had an entrepreneur I love, and he took me out to lunch once for a thank you pre-exit. I had introduced him to his Series C investor who introduced him to the company that bought him. And at the time, he said, Ben, you've been my most valuable investor. You've been great, blah, blah, blah. Now, I like compliments like everybody, but my real ambition is, that's nice. Now help me learn and grow.
Yeah.
So my first question was, who else was valuable? And he said, it was just you. I was
so
like,
this whole cap table with 50 people on it, you're the only one who put in any damn work. Everybody else was drafting.
I mean, this was post A or B.
Right.
But my thought was, so first of all, you've just wiped out the compliment. It's like, great, I'm the tallest dwarf.
Right.
What does that do for me?
Yeah.
I said, but wait a minute. I put in this much. The guy that led your round put in 25 times more money than I did. What about him? And you know his answer? I can't get on his calendar. He doesn't answer my emails. And it takes him 8 reminders to fulfill any promise that he offers me.
Wow.
And I was like, wow.
Some people just get high on their own supply.
You know that investor, by the way. I'll give you a clue. He and I sat next to each other at one of your judgings.
Oh, interesting.
But when that exit happened, I made 58x on that deal.
Yeah.
That guy made 25 times the 58x I made, and apparently I'm the guy that did all the work. And it's a weird...
And he made 25 times because he had such a bigger number in there. Yeah.
So it's that part's frustrating because you go back and you say to yourself...
Yeah, this is why I think doing the syndicate is so important. But go ahead. You go back to yourself and you say...
Well, there's another poker analogy here. Poker has so many lessons for entrepreneurs and for investors. It's the money you don't bet is the money you lose when you win. The money you don't bet is the money you lose when you don't win. So you have when you win. Right. When you win that hand.
Right.
When you win and you didn't go all in.
Yeah.
When you have aces and the flop comes up king, I don't know, I'm making stuff up, and you don't get your money in, but then you win. That money you don't bet is the money you lose. So when you put in 25 instead of 50 or 50 instead of 100, that's the money you don't bet. So when you win, man, does it suck to look back and say,
I didn't maximize.
Should have had some balls.
Yeah, should have had some guts there for sure. Okay, take us through the one company that lost, that failed, that just breaks your heart because either it didn't need to or it should exist in the world. But just, everybody has the one, not the one that got away, but the one that it didn't work out.
So that was the very first company to go down. I'll not name it because of the way I'm going to talk about it. I did not have any companies in my portfolio fail for 3 years. And I worried about that a lot because I thought to myself, you're being too picky or there's something wrong here. You're not taking enough risk. How can you have 3 years when you bet on PowerPoint slides and nobody fails? But it also reminded me of the importance of tenacity. Anyway, this entrepreneur went to zero. Actually, I think we got 6 cents on the dollar back or 12 cents. He gave us his signing bonus, which I respect.
Yeah. That's kind, yeah.
Yeah. But I remember I walked into my house and my wife looked at me and I was very down because this is 3 years in, I had my first failure. And by the way, I've lost well under 10% of invested capital. So I've been fortunate to not have many of these. Doesn't mean those companies are all going to make it, but at least they're still trying to get it done. And she looks at me, she's like, what's wrong? And I said, I had my first company go down today. And she said, well, tell me about that. What happened? I said, it's just been really hard on this entrepreneur. He's been selling ahead for so long. It's always next quarter. It's been so hard. He's not a natural salesperson. And it's been a year and it's been real. And she looked at me, she's like, a year? And I was like, you're right. That motherfucker, he gave up because he did. Yes, it was hard. It's always hard.
Yeah, that's what you're signing up for, hard.
But a year? Yeah. I remember I told you I started my company in 93. We took it public in 99. Yeah. You know how much money we raised other than my own before we signed the underwriter's letter?
No.
$100,000.
Right.
6 years of sweat.
Bootstrap.
To get to an IPO.
The classic bootstrap.
Right.
Yeah, you killed what you ate what you killed.
Right. So here's my wife looking at me, remembering those days, going, how do you think that was hard? And it was an eye-opening moment that reminded me of, even though I believed always that tenacity is the most important thing, how critically I need it. Yeah. You can fail. I will not fault you for failing as long as you did everything you could.
Yeah, there's a lot of phoning it in going now. I think a lot of people have a premise that what's important in life is balance and experiences. Do you buy into this, that you can be an entrepreneur and have balance in your life in the venture-backed, technology space?
There's an old saying I'm sure you remember from the New York days.
Yeah.
You can sleep when you're dead.
Right.
That really means you can sleep once you get liquidity.
Right.
Balance isn't a privilege you get. Now, over time, you do the best you can. They say work, family, golf, choose any two. if work is you doing a startup, good luck.
Yeah.
Now, my wife and I made an agreement at one point where she said, I understand who you are.
Right.
I know you're an entrepreneur. You've always been an entrepreneur. But we're about to have our first child. And she said, I don't care if you pull all-nighters Monday through Thursday. The weekends are for us. And we lived to that. It was hard, but with few exceptions, my IPO roadshow, a trade show we did every year, I lived to that. And I am glad I did because it is really, really hard to have balance. Is it possible? Maybe it worked out for me, but my scariest moment in my youth was I went to Babson where we have these great entrepreneurial professors. They pretty much originated entrepreneurship as a process in teaching. And one of my professors said to me once, to our whole little group, Bill Bygraves, he said, I will tell you, having been an entrepreneur, that to do it right is a dangerous and risky thing in many ways. If I had been asked to choose between my family and my business, I'm not convinced my family would have won.
Wow.
And that stuck with me forever.
Yeah.
And I feared that forever.
That's dark. It's
because
dark.
It is a reality.
Yeah.
And finding ways for it not to be a choice.
Yeah.
Look, I had an entrepreneur that's about to have, it looks like they'll have a tremendous exit. I mean, their revenue is in the many hundreds of millions of dollars. And about 3 years ago, we sat down and he said, what do I do? The world has changed. I thought it was going to take 4 years and it's going to take 10. I was like, wait, remember when we first met? I said it was a 7 to 10 year journey. He's like, yeah, but I didn't really believe you. And he said, but I don't know if I can make it. I mean, should I just sell now? And I said, look, if you sell now, you're going to get shit. You're going to get a terrible deal. And I said, why would you do that? Why would you give up now? And he said, well, my wife is having a very hard time with this. And I said, look, your real question isn't should you sell. Your real question is what's the conversation you're going to have with your wife about the reality ahead of you?
Right.
And the conversation I recommended was, honey, this is my one chance in life to make this meaningful. I may be able to have another one, but this one I have to do right.
Right.
I need you to be able to find a way to support me for the next 3 years, which are going to be incredibly hard.
Yeah.
And he actually, it was one of the best thank you notes I ever got was that conversation changed his ability to do what he did, and he was so appreciative of the help to think about how to have it.
It is such a the industry and what we do is there's so many it's so humanistic. We talk about how to make these bets and how the legal devices and total addressable market and acquisition. At the end of the day, these are humans.
Yeah.
And humans deal with human issues. And I always give a toast at our incubator and at our event dinners to the spouses. Because male or female, wife or husband, husband and husband, wife and wife, whatever this dynamic is, the amount of sacrifice that the spouse has to make at times is colossal. And I've had this discussion in, over a decade with my wife 5 times. Like basically it's an every other year discussion where we have to sit down and say, hey, what level of sacrifice do we want to have? And like we had it this past year and I said, here's what I'm going to do. I'm going to shut the company down for 3 weeks a year. 2 weeks over the holidays. It's very similar to your weekend conversation. 2 weeks over the holidays, nobody will work. Everybody will have to take off. And then 1 week before Burning Man Labor Day. Those 3 weeks, because nothing gets done in technology anyway, those 3 weeks will be sacrosanct. You can book them now. Book any trip, anywhere, any price, I don't care. But that will be, 21 days on the calendar that I am completely going to be unplugged because my team is not going to be allowed to work those weeks.
Right. And pre-booking, it allows that luxury.
Exactly. And you know what? I just told my team, like, everybody gets a raise. So if you wind up getting a raise of 3, 4, 5, 6, 7%, it's going to net out to you can take those days off or take extra vacation days. If you want to take time off without pay, whatever, if it's not enough days, I'll advance you the days, whatever. But I just said, you know what? I need to slow down because I don't want to miss these years with my girls. And I'm thinking those vacations will be the memories. Those vacations will be the pictures. Those vacations will be the time Daddy took us to Sydney.
I agree with the mindset.
Yeah.
The one thing I'll push back on a little bit, I remember when the founder of Republic of Tea, who was the ex-founder of Banana Republic, stood on stage in a small group and talked to us about...
He likes his Republic naming, huh?
Yeah, he does. He talked about, balance and life, stop and smell the flowers, and I was a young entrepreneur at the time. You know what I remember thinking?
What?
Screw you, pal.
Yeah.
You already made it.
Yeah.
Why don't you talk to me about this when you're in the trenches?
Yeah.
It is age dependent.
It totally is, and nobody wants to talk about this.
Yeah, when you don't have kids, you know the time to be an entrepreneur, the time to take risks? Single, recently married, but not having children yet. As a couple, I mean,
you have energy and time.
It changes. The risk, I will always remember, similar to your conversation, the greatest gift I ever was given or earned was having a wonderful wife I don't deserve.
Right.
Who has always been supportive. She even funded the spread at one point.
Wow.
She came from a better background financially than I did.
Huh.
But I remember when I started fashionmall.com, I came to her and said, I want to start this business. I want to talk to you about it. She said, well, you always start business. I said, no, this is different. The business I have today is making us, for the first time ever, a really healthy living. It is what currently is called a lifestyle business.
Right.
A term I never heard until I moved to Silicon Valley. But if I do this thing, this web thing, and I am wrong, I will be bankrupt and unemployable because it is going to take everything I've ever made.
Right.
And I'm going to roll it all into this thing. And I will tell you right now, I don't know anybody else that's doing this.
And this is at a time, though, with no kids.
Correct.
Married, but no kids.
Right. And so, well, I don't even think we were married yet.
So
Although, actually, I guess we were just about to get married.
Right around
So it was that moment. And you know what the difference between me being able to do that and not being able to do it was her saying, you are who you are.
Yeah. And
being willing to go along with it. And I was not exaggerating, by the way, because I am probably unemployable in the traditional role of being in a job. And that business stared into the valley of death. We were about to miss payroll. I mean, we lived through it. So balance is something I think you earn later.
Right. I'm with you on that.
And there's places to get it. Obviously, meditation's been increasingly interesting to people. And I love to, not yet, I keep trying.
Calm.com.
I like to just appreciate things around me. Like you can take a moment. There was this not great movie called something like the Collateral Beauty, which I don't care about the movie, but I liked the idea of sometimes you just stop and you look at the bridge.
Right.
You look at the fog. You sit in some trees and you have a meal. You have some peace.
Yeah, you're present at that moment.
Yeah, and it's hard, but you'll get there. You can sleep when you're dead.
Yeah, people, I think, have this idea like, oh, I'm going to, rack up all these experiences when I'm young, and it really is a great opportunity if you want to build a business to do it in your 20s. Is so much easier because you don't have kids and
you're resilient.
You're resilient, and you don't need
modest.
sleep, and you can just work 7 days a week and get yourself there. All right, listen, Ben Narasin, I got it right. Narasin. Ben Narasin.
Hey, you got it right there. 20 years in.
Yeah, 20 years in. Now I have dyslexia, so Narasin is B Narasin on the Twitter. BNARASIN. And you can join his syndicate on AngelList, I assume. He's somewhere on AngelList, which is angel.co. And continued success, my friend. It's been great to spend some more time together. And you're going to be at Launch Scale, I understand.
Yeah.
So if you didn't get enough Ben from this episode, come to Launch Scale. Launch Scale is launchscale.net. And that is our event on October 17th and 18th here in San Francisco. And it's for companies that are launched, investors who want to meet those companies and that are trying to grow. So you got your seed, angel, friends and family, bootstrapped to a product, and now you want to grow the company. All the talks are around growth. Personal growth with Loic. Ben, what are you talking about?
I don't think we've decided.
We haven't decided yet, so we'll get on that. But you can go take a look at the schedule at launchscale.net, launchscale.net. Go ahead and you can also buy a remote ticket. For the first time this year, we're doing a really affordable $199 ticket. If you're anywhere around the world, you can buy that ticket, and you'll get all the videos. You'll get to watch the streams live, thanks to all this great live streaming technology we have, and you'll be able to ask questions. Now, we won't be able to get to all of them, but we will take the first question, as our tradition, comes from the live stream. So being on the live stream actually gives you an advantage over the in-person crowd, as we give the first question to the live stream. And there's all kinds of dinners, and the tickets are super affordable. In fact, we give, I think, 90% of the tickets away for free to founders, and then we sell the last 10%. We've already given away those 90% for free, so you missed those. But go to the website and look at the amazing speakers, just some of the best entrepreneurs and investors in the world. In fact, I can tell you, the best entrepreneurs and investors in the world are coming. All right, well, if you like angelpodcast.com, subscribe on YouTube, SoundCloud, iTunes, Spotify, wherever great podcasts are found. And please write a review. Take the time. If you enjoyed this conversation, you made it all the way to the 70th minute, go ahead and write a review, rate and write the podcast. Write a review and rate the podcast. That really helps us climb the rankings. I hate to beg for reviews, but it really is critical. Okay, that's the world we live in, Ben. I'm still hustling, huh?
Always be selling.
When does it stop?
Never.
It never stops. You got to hustle.
I funded a company called Hustle, and the reason he loves me is because he says I hustle harder than any other investor.
Here's the thing about hustling. Like, never be ashamed to hustle. I find people, I'm like, who have you called to try to raise money or whatever? And like, well, I called these 7 people I know. I'm like, you got to get to 70. You got to learn to hustle. Get out there.
There's a great saying from a movie. I'll close with this one.
Yeah.
If selling is like shaving. If you don't do it every day, you're a bum.
I love it. Coffee is for closers. Let's go. These are the Glengarry.
I'm glad I was a closer.
These are the Glengarry leads. All right, we'll see you all. Yeah, on the cups. We'll see you all next time on Angel the Podcast.